Hey everybody, it's Christian Madarasz, and I'm just doing this video in Chapter 4 of the College Accounting 13th Canadian Edition text. So in this chapter, you go through the process of doing adjustments, and adjustments can be a bit challenging for some students. It's one of the times that we use the journal entries to change some of the expense items or asset items. And let's just get started on it, and I'll work my way through. So going through the transaction cycle, just as a refresher. So you get transactions, then you go through the analysis process, then you prepare journal entries. Those journal entries are then posted from the general journal to the general ledger, and then those balances in the general ledger are created into a trial balance. So this trial balance is the check. It's basically the place where you double check to make sure that your debits equal your credits. After that, after the trial balance, we do what is called the worksheet. So a worksheet is an area that we would put the trial balance in and then figure out what adjustments need to be made. So the worksheet has a good example of the worksheet is actually in your textbook, and it's a big columnar pad. I completed ones on page 221 that shows the totals, the adjustments, the adjusted trial balance, income statement and balance sheet portions. So go through the text and make sure you understand that stuff. So these adjusting entries, they're internal transactions, and they're meant to bring the accounts up to date. So what that means is that they're bringing, for example, many of you have been talking in the discussion groups about supplies and how supplies can be an asset or they can be an expense. So they're an asset until they're actually used for the business, and once they're used, that value is transferred to an expense. And to do that, we have to do an adjusting entry. So this has got to do with the recognition principle, which recognizes the revenues when they're earned and the expenses when they're incurred. So very often things that need to be adjusted are the store supplies. We also adjust prepaid items such as rent or advertising. We record depreciation. So what that means is if I buy a car or a vehicle for the business, and that vehicle costs $30,000, I don't just say everything's an expense, because that vehicle will have a certain life. And that life is the amount of time that this vehicle will be used in the business. So what we do is we call depreciation that cost that is transferred from the original cost over to an expense. And then other things that can be adjusted for at the end of the year are salaries or some other rental expenses and things like that. So in this example, they have two entries. The first entry says that there were supplies purchased for $800, and then on the 20th of January there was a second purchase of supplies for $600. So this is in the supplies asset account. This is how much was available for the month of January. At the end of the month, they go through the supply closet and they add everything up that's left in there, and they say, you know what, there's about $300 left in inventory. So with supplies, you'll be asked questions in two ways. One way is to say there is supplies on hand at the end of a certain period of blank dollars. So in this case, it says supplies on hand January 31st, $300. Or you'll be told that the supplies used for January were $1,100. Okay, so there's two ways that they'll word it, so be careful on the wording when you go through this. So in this case, it says the supplies on hand, so they counted up the value and they said there was $300 left. So what you need to do with this T account is make sure that at the end, remember we had $1,400 earlier, at the end we have to make sure we have $300 left. So to do that, we need to take $1,100 out of the supplies asset account and transfer that over to a supplies expense. So that entry will be a credit because it's reducing the supplies asset account, and then a debit to the supplies expense account. Other types of adjustments include adjusting for prepaid rent. So very often businesses will come and they'll say, you know what, I've got some startup capital, so here's $3,000 for 6 months rent. Now we don't just say $3,000 rent expense January 1st. What we do is we would say $3,000 of prepaid rent when the payment's made, and then every month we make an adjustment. So in this case, each month's adjustment would be for 1/6 or $500, 3,000 divided by the 6 months. So every month we record $500 of rent expense. So the initial entry said, here's the $3,000 in the prepaid rent. And every month, we're going to take $500 credit to the prepaid rent and make an entry for $500 debit to the rent expense. Okay, makes sense? So depreciation is a bit of a tricky subject. What we do is we look at the cost, and then we say, well, you know what? If I bought this $30,000 vehicle and I'm going to keep it for 10 years, let's say, at the end of that 10 years, that $30,000 vehicle may be worth $5,000. So I would take my $30,000 vehicle, subtract the residual value, which is the $5,000, and then divide it by my estimated years of usefulness, which in this case would be 10 years. So we take 30,000 minus 5,000, so that equals 25,000, divided by 10. So every year, that vehicle would be depreciated at $2,500. Now let's see what example they have in the book. In the book, they say, on January 1st, I purchased equipment for $14,000. It's estimated that we'll be using this equipment for 5 years, at which time it'll be worth $800. So the first entry I do is I say, I'm going to record this equipment because it cost me $14,000. And maybe I paid for it with cash or whatever. But next thing I need to do is when it's time to do the depreciation, I say, what's my cost, which is $14,000. I subtract what the residual value is, so I subtract $800, and then I divide it by the number of years that I'll be using it, which is 5 years. So that means that every year we will take $2,640, or for 1 month we would take $220 of depreciation. So in this example, we record the $14,000. Now we don't reduce this account by the depreciation. The cost is still the cost, and it's a really important accounting principle to say that assets are recorded at cost, and they stay at cost until they're sold. So we have this other account which is called a contra asset. So a contra asset is something that normally has a credit balance as an asset, and this one's called accumulated depreciation equipment. So over time, this account, this accumulated depreciation account, will grow in value. So this month we're saying $220 depreciation expense, so this goes on the income statement, and on the balance sheet is $220 credit. The book value is the difference between the cost and whatever this accumulated value is. So in this case, we have $220. And this is the book value, $13,780. So this is an important thing to know. This historical cost, this $14,000, doesn't change. You do not reduce that cost. And when you present this on the balance sheet, you show it in this way: equipment less accumulated depreciation. So you take $14,000 less the $220 will give you $13,780, which is a book value which is shown beside the figure. So this is the contra asset, as I said, and it accumulates over time. So the next month, there would be a further $220. So that means that this accumulated account has now grown to $1,440. That decreases the book value. So again, we wouldn't record this entry as anything other than the equipment stays at $14,000. It's this accumulated account that grows with the depreciation over time. Another adjustment that we make in this course is for accrued expenses, and the most common accrued expense that we have is for salaries. So, for example, it says here salaries are $100 a day for a 5-day work week. This runs from Monday through Friday, and employees are paid every Friday. So if you look at this calendar, the employees are paid on the 5th, on the 12th, on the 19th, and on the 26th. At the end of January, we actually owe the employees 3 days worth of pay. So that 3 days worth of pay, when we do up the books, they actually wouldn't show up because we haven't written the checks yet. So what we need to do is we need to say, okay, we have to accrue some expenses. We have to say that these were actually owed to the employees. So if something's owed to somebody, the other side would be a payable. I owe that money. I have a payable. So I have an expense that I'm incurring, which is the salaries expense, and I have an accrual or an amount owing, a payable, a liability, whatever you want to call it, on the other side. So what I would do on January 31st, so January 5th, I say, well, there is $500. January 12th, $500. January 19th, $500. January 26th, $500. And then on January 31st, let's change that because that's a bad slide. On January 31st, we would record $300. So for this slide, ignore this. This would be what happens on February the 2nd. But we're not in February, we're just in January. So on January 31st, we say, you know what? They actually were owed $300. So we add $300 and then we set up a salary payable of $300 on the other side. Okay, so those are some of the basic adjustments that you need to understand. The next part is doing the adjusted trial balance. So in this one, we're going to use the exercises, problems 4-2B. These are on page 183 of the text. So there they have a trial balance. When we start the worksheet, we just take the trial balance numbers from the example and record it on the left side of the worksheet. Then we go through the question. So it says, okay, painting supplies on hand over $595. So the $595 means that the ending balance was counted at $595. We need to determine how to get there. So to do that, we take $326 away. $921 start, $595 finished. So $326 must be the difference. By using the T account, we can see whether it's a debit or a credit. So in this case, it's a credit entry. So I'm going to credit my painting supplies asset account and debit my painting supplies expense account. So that's the T sheet way, the T account. And then when I go to my adjustments column, I'm going to say, well, here's the first adjustment that I have. My supplies expense, it's not listed down here yet, so I write it in, $326. My supplies asset, $326. Debits in the debit column, credits in the credit column. I also put a letter reference so that I know which adjustment this applies to. Next, it says the rent, prepaid rent represents the first and last month's rent on a new office lease signed November 1st, 2018. Okay, so the prepaid rent, if I look at my prepaid rent, it says $850. It represents the first and the last month's rent. So it represents, I signed this November 1st, and this trial balance was November 30th. This represents the first and last month's rent. So what that means is that it's paying for November plus it's paying an extra month for when we decide to end the lease. So now that November is finished, we have to recognize that, okay, we've used up 1 month of this rent. So my prepaid rent account is going to decrease by $425. And the next account, which should say rent expense, is going to increase by $425. So I'm going to credit my prepaid rent, debit my rent expense. The depreciation on the equipment, it says depreciation on studio equipment and based on a straight line, 5-year life, and a residual value of $480. So it says my studio equipment was $59.85. The residual value was $480. So I take $5,985, subtract the $480, which gives me $5,505, divide it by the 5 years, gives me $1,101. Now, because we're doing a 1 month period, I need to figure out what the monthly depreciation is. So I take 1101 divided by 12, gives me $91.75 per month. I record the depreciation expense in my Teach account up to $91.75, and my accumulated depreciation gets increased by $91.75. I put that into my adjustments. So again, the depreciation expense was not showing, so I write it down, $91.75. This is an income statement account. And the accumulated depreciation, I'm increasing this by $91.75, so I record the credit. Entry D, it says wages earned but unpaid amounted to 24.5 hours at $10 an hour. So 24.5 hours times 10 is $245. So my adjustment is going to be owing $245 for that period, and $245 as the expense. I record the entry as a $245 wage expense. And I don't have wages payable, so I write it down at the bottom, $245. So this is a common spot where students will make errors. Well, as we're doing this stuff is all nicely laid out. So it starts out with assets, and then it goes into liabilities, and then equities, revenues and expenses, and everything else seems to be expenses. Very often students will take this wages payable and plunk this into the income statement column. That's a big mistake. This is actually a liability account. So when you're doing this, you have to make sure that you capture this payable in the liabilities, which means it goes into the balance sheet. So to do the adjusted trial balance, I simply take whatever the balance is. If it's a debit balance, I add the debits, subtract the credits, and do everything across. So I have debit less a credit gives me $425. Debit less a credit gives me $595. And I just go through this process of figuring out what the new adjusted balance is. Note that I've footed these column totals. So my debits equal my credits. That's the first thing you should do after you do the adjustments to make sure there's no mistakes there. Then do your adjusted trial balance, and again, foot the totals. When you foot these totals, debits should equal credits. If they don't, that means you have a mistake. No sense continuing until you find that mistake. So the next sections I've gone through, I've got my adjusted trial balance. So this is basically the same as here. They've just slid the sheet over. There's all the numbers, and they've highlighted. They said, okay, here's your balance sheet account, and also this one's a balance sheet account. So as I transfer these numbers over, I'll be transferring all the balance sheet numbers over to the balance sheet accounts, including this 245. I'm going to transfer these income statement accounts over to the income statement area. Okay, pretty straightforward. The next thing is adding up the columns. Now these will not balance. So these debits and credits, well, actually they might balance if it was a total break even. But for the most part in this course, they will not equal each other. So what we need to do is say, I need to make this add up. And we only ever add, so I wouldn't subtract, I wouldn't put 3690 in this column to bring everything down to 4125. I need to add a number. So this is important. I'm adding 3690 to make these balance. This number needs to be the same as this number. If they are, then everything balances. This number, the 3690, represents the net income that you have. So the 3690 is the net income. The 3690 is the amount that's going to be added into this capital number to make this side balance. If this was reversed and you had numbers in here that had to add up, these would be deemed a loss. So that's just something to look at later on. So I go through, I take my income statement from these figures. So I've got my income statement figures, and then I prepare my income statement. And this is the same process that you went through before. So I start preparing the income statement. I take the balances from the adjusted trial balance from the worksheet. There's my entries, provides me with my net income. I transfer that net income over to my statement of owner's equity. So I say, here's my beginning balance. Remember, it's for the month ended. It's not just November 30th. It's for the month period ended. There's my beginning balance. There's my income. So my income comes from here. That gives me my balance at November 30th. Then I go to my capital on my balance sheet. So my income at November 30th was $9,518.25. There it is. I record my assets. Here I have my equipment. Notice how I indented over and then show the book value in one column. Dollar sign at the top of every column. Dollar sign at the top of every column. There should be lines under here. They're not showing for some reason on this screen, but there should be a line under depreciation. Under here, I mean, double underlines under the totals. So, last step. You've calculated the adjustments, but there's been no journalizing. It's just sitting in the worksheets. So we need to make sure that these actually get recorded into the general ledger accounts. Right now they haven't been. So this is another step that students often miss is they go through and they prepare the worksheet, and then they just assume that, okay, I'm done. Everything's, I've done my financial statements, but there's the last step, which is journalizing and posting the adjusting entries. You don't use the worksheet as a spot to post from. The worksheet is just like a scrap piece of paper. At the end, you could probably toss it away. Not that we would, but you could. So what I do is I go through the process of saying, here's all my adjustments that needed to be made. Now, if I didn't have letters beside them, it might be a little bit difficult for me to figure out how the adjustments should be posted. But because I've put letters, and on the Excel sheets, if you can insert an extra column, it'll make it easier to put letters in. Otherwise, just start with the letter and then manually add everything up. So I'm going to look at the A's and say, okay, so the first journal entry is going to be adjusting the painting expense. So I'm going to say debit 326, painting supplies expense, credit painting supplies asset for the 326. Don't forget, put in the, on this, they don't show it just to save space, but in this next spot, put a description saying year-end adjustment. Leave a space to the rent expense. So the rent adjustment, 425 debit, prepaid is 425 credit, so debit my expense, credit. Say adjust prepaids. I record my depreciation, debit depreciation, credit accumulated depreciation, and then do my wage expense and credit my wage payable. Then I would post those. So remember, the process of posting is I take the amount, I go to the general ledger account, I write it into the credit, I say where it came from, and then I would go back to the general journal, and in the posting reference, I'd say where did it go to. So I would say it went to account 113. So that's it. It's actually, there's one page for the assignment to do, and there's 4 or 5 entries to do. But this is the spot that the bookkeeping actually starts to take off. So this is the point in the course where things will get a little bit more complex. It's a big chapter. So take your time going through it. Feel free to ask questions, and I'll see you online.